Here's 4 best ETFs to pair with VOO to get rich easily. VOO is one of the most popular S&P 500 ETFs in the long-term investing world, alongside other great names like SPY and SPLG. Tracking the hardest index to beat known to investor mankind, that being the S&P 500. VOO has also had outstanding performance, delivering over 13% annually over the last 10 years and over 15% annually over the last 5 years, making it nearly impossible to beat the performance of this index fund over a long enough period of time, where financial gurus and hedge fund managers even underperformed the S&P 500, even VOO. Now, I currently have well over $65,000 invested in VOO, Vanguard's S&P 500 ETF, a staggering 124 shares, $13,000 in gains from this ETF, so I'm without a doubt heavily invested in VOO. VOO by itself can hold its own as a 1 ETF portfolio. I know that many people are curious or perhaps interested in investing in one more ETF to have a 2 ETF portfolio, with VOO being that core holding. So I found 4 different ETFs that pair great with VOO to provide high growth in terms of capital appreciation, perhaps way more added diversification, or more dividends for passive income to live off of dividends. I'm going to make sure all 4 of the ETFs in this video have a low fund overlap. And a low fund overlap essentially means that we have increased our chances of diversification, as well as have a less concentrated portfolio, both of which are great things for long-term investing. So without further ado, let's get started. The first type of ETF is a growth ETF. There's so many growth ETFs to choose from that can complement VOO very well, so here's a ton of ones to choose from, but I'm going to choose VGT by Vanguard since it's in the same family tree as VOO, but any of these ones on your screen are excellent choices. In terms of fund overlap, VOO and VGT have a fund overlap of 31%. Now this might seem high, but smallcase.com says that investors should aim to keep a fund overlap percentage of less than 33%, while generative AI says no more than 50% for ETFs. So VGT and VOO can pair well together. VGT has a low expense ratio and A grade by Seeking Alpha. It has a low dividend yield of around 0.6%, but that's okay because VOO has a yield of well over 1%, so if we pair both these ETFs together at a 50-50 split to both these ETFs, it will give you a boosted yield to nearly 1%, which may not seem like a lot, but hey, it's better than nothing. VGT's top holdings are Apple, Nvidia, Microsoft, Broadcom, Adobe, and Salesforce, with its top sector being 100% to technology, split up into subcategories of the tech sector like semiconductors and system software. Since technology and semiconductors have been the place to be in the stock market for the last decade or so, this area can offer amazing outperformance of returns. So combining both these ETFs will definitely give you more exposure to those high growth sectors of the market, as well as to provide more upside potential in your portfolio. This portfolio is definitely meant for people who have a high risk tolerance, can stomach volatility, a long time horizon, does not prioritize dividends, and would rather prioritize capital appreciation to have the highest upside potential in the stock market. Given this portfolio has a beta of 1.08, it does have a slightly higher beta than normal. A high beta means a stock is more volatile than the overall market and is considered more riskier for investors, but it could also provide potentially higher returns, or in dummy terms, it's going to be 8% more volatile than the overall market. VGT has had impressive performance, delivering over 20% annually over the last 10 years and over 23% annually, yes, 23% over the last 5 years. So if you add a growth ETF like VGT, you will definitely not miss out on any opportunities of those insane returns that the growth and tech sector of the market has to offer. If we combine both these ETFs using a portfolio backtester at a 50-50% allocation to each fund, the 10-year annual return is around 17%, which is going to be nearly 4% higher than only buying VOO. And if we invested $100,000 in this 2 ETF portfolio, you would end up with around $460,000 over the last decade, compared to only buying VOO with around $330,000. The second ETF is a dividend ETF. Not all dividend ETFs are made the same, so here's some of the best ones I like that provide dividend growth or that pay a dividend, but I'm going to go with SCHD by Charles Schwab. In terms of fund overlap, SCHD and VOO have a low fund overlap of only 8%. The reason why SCHD pairs great with VOO is because the technology sector is the majority sector holding in VOO, which is usually a lower holding in dividend ETFs, especially with SCHD. Then pairing up SCHD with VOO is going to be a great option because it does have a beta of 0.92 or 8% less volatility than the overall market. Furthermore, SCHD does have those more value-oriented dividend-paying companies, while VOO has more growth stock companies, so combining both these ETFs, you will get the best of both worlds of value and growth stock companies, and dividend ETFs do have those more defensive sectors, which can perform well and if not better than those S&P 500 counterparts during a recession. And finally, of course, they do pay a way higher dividend, which VOO obviously does not pay as high of a dividend. SCHD has a low expense ratio of 0.06%, a perfect A+ rating by Seeking Alpha. It has a great dividend yield of around 3.5% with one of the most consistent and reliable dividend growth I've seen in the stock market. Pairing a dividend fund like SCHD definitely boosts the yield with VOO to well over 2%. So if you want more dividends, perhaps you have a less risk than a growth ETFs who are less risky, and you want to have those solid returns all while snowballing your dividends way faster than usual, then this is a great combo. SCHD's top holdings are Home Depot, Bristol Myers, Chevron, BlackRock, Verizon, and Cisco Systems, with its top sectors being mostly to financials, healthcare, consumer staples, industrials, and energy. And the returns of over 11% annually over the last 10 years coupled with the returns of over 13% annually over the last 5 years are no joke. Combining both these ETFs with that 50-50 split, the 10-year annual return is 12.5%, which is going to be a touch lower than only buying VOO. And if we invested $100,000 into this 2 ETF portfolio, you would end up with a little less than $20,000 than only buying VOO. The third ETF is a small cap ETF. There's so many small cap ETFs to choose from that are great and amazing for long-term investing, but I'm going to go with a popular one, that of AVUV by Avantis. Small cap stocks are companies that have a market cap of less than $2 billion, which is relatively small compared to those mid and large cap companies. They're also more riskier and more volatile than those large cap companies, but they can also offer higher returns and more potential reward to investors. The fund overlap of AVUV and VOO is the lowest so far of 0%. Now 0% is absolutely insane and crazy to believe because small cap ETFs like AVUV can pair great with VOO for that benefit of added diversification. Why is it more diversified, you ask? Well, VOO only has large cap companies and does not have any small caps whatsoever. So if you want small caps for that benefit of diversification, then you're in for quite the treat. AVUV has an expense ratio of 0.25%, a B+ grade by Seeking Alpha. It has a dividend yield of around 1.6%, which is quite high for small caps and can definitely boost your portfolio's yield to well over 1.4% with VOO. AVUV's top holdings are SM Energy, MDU, Boise Cascade, Jackson Financial, CNX Resources, and Matson Incorporated. Its top sectors are mostly exposed to financials, industrials, consumer discretionary, and energy. With both these ETFs combined, I really do hope you have a high risk tolerance because this will be a very volatile portfolio and you do have a long time horizon because the beta of this portfolio is going to be 1.13% or 13% more volatile than the overall market. But you do get the benefit of diversification as well as the potential for amazing returns in the long run. AVUV's performance has been amazing so far, of over 15% annually over the last 5 years and over the life of the fund since late 2019. Combining both these ETFs using data from only the last 4 years, since AVUV is still a pretty new fund, the annual return is nearly 15%, which is going to be barely higher of 0.1% than only buying VOO. And if we invested $100,000 into this 2 ETF portfolio, you would end up with about $1,000 more in value than only buying VOO. The fourth ETF is an international ETF. There's definitely many forms and choices of our international funds, but I'm going to go with VXUS by Vanguard, but any of these are top tier choices. It's a no-brainer that VOO only has 100% US stocks and does not, I repeat, does not have any international stocks within the fund. So if you want to be way more diversified or globally diversified, then pairing up something like VOO with an international fund is going to give you true exposure to not only US stocks, but also stocks across the world. In terms of fund overlap, VOO and VXUS have a fund overlap of 0%, which isn't shocking at all and lets us know that this is going to be an amazing and great combo for global diversification. VXUS has a low expense ratio of 0.08%, a perfect A+ grade by Seeking Alpha. It has a solid dividend yield of around 2.8%, which is amazing for dividend lovers since international funds do pay a way higher dividend than their North America counterparts. And pairing both these ETFs will give you an amazing dividend yield of well over 2%. VXUS's top holdings are Taiwan Semiconductor, Novo, ASML, Tencent Holdings, Nestle, and Samsung. VXUS's returns have been okay, delivering over 5% annually over the last decade and over 7% annually over the last 5 years. But that's okay because this portfolio is definitely for boglehead investors who want ultimate diversification, perhaps you want a way higher dividend yield, or you want that peace of mind to know that you are invested in different segments of the market and you are globally diversified. And if we combine both these ETFs, the 10-year annual return is just under 10% and 3.5% less than only buying VOO. And if we invested $100,000 into this 2 ETF portfolio, you would end up with around $240,000 over the last decade compared to only VOO with $330,000. Now, if you guys want to see my entire $125,000 ETF portfolio, download the Blossom app for free using the link in the description of this video or in the pinned comment, and you'll see every ETF in my portfolio whenever I buy or sell an ETF, as well as I get to see your ETFs, which is going to be pretty cool to see, and you can join the fun of whenever I make any posts on the Blossom app, so be sure to give me a follow, and I will definitely give you a free follow back. If you guys like this video, please give it a like because this cute puppy did. Right here's going to be a video on some of the best ETF portfolios for long-term investing. Hopefully you guys have a great rest of your day, continue to crush in the stock market, and take it easy. Peace.